So what I'm talking about is Austrian answers to neoclassical puzzles. The things I'm going to do, most of this, like some of them are serious and some are lighthearted, and it's things where neoclassical economists, in my opinion, went down a ridiculous path, or they can't answer something that's obvious. So it's, when you say Austrian answers, I'm really not going to spend so much time on the Austrian part because it's almost more like common sense. All right. So, but it's still a strike in favor of the Austrians that we would never make this mistake, because as we'll see, these mistakes are flowing out of the neoclassical's approach to economic modeling. All right. So it's not just that we're cherry picking, and of course, if you follow anybody around for a long time, they're going to say something dumb, right? But so that's probably. Did you have a question? It would depend on the context. So for some of this stuff, I am going to be picking on people that probably would be Chicago school. Okay. And then also, so you guys know, I've set my phone alarm for 12:15. So I'm going to stop there. Well, I'll finish the sentence and then turn it over to Q&A to make sure that, because I want to make sure you guys get a big Q&A section of this. Okay. So I have, 6 of these, but I might not get through them because, like I said, I'll leave the last 15 minutes for you guys for the Q&A. Unless, if I'm saying something you just need a clarifying, what are you talking about? That's fine. But if you have a broad thing, let's say that for the end and I'll go through these. Okay, let me quickly, so the point is, just to finish that train of thought, it's somebody who's not an Austrian economist could just as well see the mistakes that we're going over and saying you don't need to be an Austrian to avoid that type of mistake. And that's true. But as we'll see, the types of mistakes we're going to document here, it's not an accident or it's not a coincidence that mainstream neoclassicals made these mistakes, because it naturally comes from the way they look at economics. All right, let me just give you 3 little anecdotes first, just to motivate this. The neoclassical people at top schools, they're not dumb. All right, so sometimes Austrians say things, like, oh, those guys at MIT are just morons, and or Paul Krugman's an idiot. And he's not an idiot. Right? I mean, he's a very sharp person. You could say a bunch of other adjectives you wanted, but it's not, being idiotic is not one of them. And so I think you're wrong if you think that, and it's going to bias your interpretation of what happened in terms of the evolution of economic thought. So guys like even John Maynard Keynes and Robert Lucas and Kenneth Arrow, they're really smart people, and so it's not so surprising that they were able to wow their colleagues and people look to them as leaders and they want to copy their techniques. Or Paul Samuelson, again, a very technically proficient economist, and he's well read, but his problem in my mind is that he knows a little bit about a lot of stuff, but he doesn't really know a lot about anything or he doesn't know enough. He knows enough in each field to be dangerous, but he doesn't know enough to realize the mistakes in what he's doing. Okay, so let me just give you 3 examples of the kind of thing I mean. And so these people I'm talking about are very sharp. One guy was in my class at NYU. That's where I went to grad school. And he was very, like I said, it's not like he was one of the dumb people in the class. He was very smart. He was from Turkey. He was really good at math. And so in NYU's program, that was a huge advantage. And so he was actually probably going to get one of the better jobs coming, the people in my cohort that went through and got their PhD. And so anyway, what was happening is the UAW, the United Auto Workers, were coming to unionize NYU's grad students. Right, and so believe it or not, I actually was part of the UAW for like a year. Right, you wouldn't have thought that. And why the UAW was unionizing grad students teaching economics, who knows? They were telling us how we were being exploited, having to grade papers to the wee hours of the night and so on. But that was the idea. And truthfully, it was hilarious to me about how outraged all the NYU grad students were getting whipped up into this frenzy about, like, I can't believe the administration, and so, because this was, so anyway, and they would do, like, to give you an example, and this is what really made me not like unions, is because I saw it firsthand. They would do stuff like, the one guy came up to me and he said, hey, did you sign your union card yet? And I said no, and he goes, well, you better, because otherwise they're going to cut off your stipend. And I thought that was kind of, because this is before like the union election. This was like registering, like to say before the thing, I want to be part of the union or something, like to give them your information so they knew who you were. And I thought that's kind of weird that we're technically not even in the union yet and you're threatened. So I went and checked with the administration people and they said, no, you're going to keep getting your stipend checks. Right? So I mean, stuff like that was a little bit like he technically, whether he was misinformed or lied, we don't know. But clearly he was trying to bully me into signing up. And unfortunately, these were all like wussy grad students, so they couldn't like muscle me. I'm tough standing up to union people when it's grad students. At a construction site, I would have said, okay, I'll sign the union card. And then another thing they did that was a little bit dishonest is so the economics professors would ask the administration. They say, hey, in our classes we're teaching economics, and kids are asking us, what do you think about this unionization effort? Is that a good thing? What would happen? And so they said, we know there's labor laws, and so what can we say in that thing? And so the administration sent out a memo saying, you're right, there's all sorts of labor laws about this, because what you can't do if you're an employer and the union comes and tries to unionize your workers, you can't get up and say to all your workers, if you guys vote the union in, we're going out of business and I'm firing you all and we're going to move the plant to South Carolina. That's illegal for you to threaten them like that, okay? So there's a little bit awkward in this situation. What's the analogy for economics professors that said, yeah, you can be very vague and say things like, well, if we imagine there's a plant and unions come in, it could raise the cost of labor, but he said, but you cannot say anything like, I think there'd be fewer students able to get fellowships at NYU if you guys vote for the union. He said, you cannot say that, that's illegal, don't say that. So the union got a hold of this memo and puts up big posters all over campus with the title, Administration Tells Professors How to Break the Law and Get Away with It. All right, when really they were just clarifying what the law was and saying, don't say this stuff because that's illegal. Okay, so anyway, the point of this is though, so we're in meetings and the administration, like the provost, is going around meeting with all the departments to try to understand, why do you guys want to bring in a union? This is going to bring another, bureaucracy. We're going to have this outside group intermediating between us and grad students. Why are you guys so unhappy? And so the students are complaining about the stuff, and one guy, so again, he's getting a PhD in economics from NYU, which is like a top 20 school at the time. And he said, well, we want subsidies for apartment, for, housing, because, the grad students live on campus, and the guy said, oh, okay. And he said, because Columbia students, they get that. They, as part of their package as a fellowship, they get some money, and then they also get subsidies on how much they have to pay for their apartment rents in Columbia's housing. So the guy said, okay, we can do that, but we're going to have to then lower your stipend. So right now there's a pile of money, and we're giving it to you every month for you to come here and get your PhD. And they said, if you want us to give you a break on housing, we can do that, but then the pile of money has to get smaller. So if that's what you want, we'll do that. And the kid said, no, you don't have to lower the stipend, because since NYU owns the apartment building, it doesn't cost you anything, right? And this is a kid getting a PhD from NYU in economics. And so I just see the pro, because this guy now, he has to go talk to the sociology department, and he's getting this from the Economist, right? So he was, clearly flustered, but, he's trying to explain, well, no, there's, opportunity cost, and, it costs us money if we lower the rent that we could have been renting out to somebody on the open market. It costs us money. Anyway, so that's one example. And the reason I think that happened is because, again, this guy was by the professional standards, he was one of our better students. Like, he was going to get a great job on the market and so on. And so people would have thought, oh, he's a really good economist, when really what it was, he was a really good mathematician. But he didn't even, I don't even think he'd ever taken what we would consider to be an economics principles course. He certainly had never read Henry Hazlitt's Economics in one lesson. So, things that probably most of you knew when you were very young, this guy didn't know, but the reason he was able to go through and get a PhD from a great school is because what it mostly consisted of was solving, models for equilibrium states. All right, let me skip the other two anecdotes aren't so great. Let me just skip those and get right into the puzzles. So the first one is called the equity premium puzzle, and I guess I can write that down. So what it's referring to, the equity premium puzzle, is that if you look at the return on certain investments, financial instruments, it seems like the expected or the average return on stocks is higher than it should be compared to things like government bonds. All right. So the way in the finance literature, the way it works is they typically assume that U.S. government bonds are riskless, right? And so that's considered a safe asset. And so the return on those is considered to be just due to the pure time preference or worried about inflation, that sort of thing. There's no risk of default that they assume in the model. And they know that's a little bit unrealistic, but they say, come on, the U.S. government's not going to default on its debt, right? And then if you look at those returns compared to the average return in the stock market, like the S&P 500, again, it seems like so it's a premium on equities, that the return to stocks is higher than the return on safe government bonds. That makes sense, but their point is the degree to which it's higher is a puzzle. Like, why is it such a big degree, such a big difference? Because when you look at the volatility of the stock market compared to the volatility of, returns on safe government bonds, which, there's no volatility because they assume it's riskless, it doesn't make sense because they look at micro experiments. When they test people in the lab with, behavioral economics and experimental economics, and they try to gauge, people's willingness to take on more risk for more return and so on, and they have those micro results and they apply it to the large financial markets, and again, it doesn't seem to make sense. The only way they can explain the equity premium is by assuming people have this aversion to risk that they know just doesn't fit with the laboratory data, that it makes people extremely risk averse in order for them to need such a high return in the stock market. So one way to solve the problem, though, is to realize that the stock returns aren't normally distributed. All right. So what I mean is, if the return on a stock, it's not a smooth bell curve. So that's the assumption. It's actually broader than that. For those of you who know the terms, it's more of it's called a Gaussian distribution. So it doesn't have to be the nice, cute bell curve, but the point is the distribution of what a stock return is going to be looks like this. So yeah, there's a chance that, so maybe this means like this, it returns 5% a year, and it could possibly return, 250% a year, but it's very unlikely. In the same token, it might drop 90% in a given year. But again, the probability is extremely small. And so because they have this kind of assumption of what the stock can do, people ought to be more willing to take on stocks in their portfolios, and yet they don't in practice. But so again, the one way you just solve this is if all you do is relax the assumption of this normal distribution. And so if instead of this, the real distribution is more like this, right? So what's called fat tails, meaning that there's more probability area under these extreme tail end events. That right there would solve the problem. So of course, the Austrians aren't, I'm not saying the Austrian approach is to say, let's assume this different probability distribution. That's not what I'm saying. But the point is what the mainstream people are doing without even realizing it is their harmless assumption of the normal distribution is what's driving the anomalous result. And so if you relax that a little bit, then you see that this apparent puzzle disappears. So to put it in plain English, the reason people are afraid to put more of their wealth into stocks is that they know on any given year there's a chance there could be a crash. Whereas with the model that's trying to model their behavior that the mainstream people use, the chance of the stock market crashing is extremely small. To give you some idea, like with the recent housing crash, in those models, that event was supposed to be something like that would happen every 100,000 years. And yet, so technically, the fact that it just happened, it still could have been a 1 in 100,000 event, but probably it was a lot more likely than their model was plugging in. Okay, if you get what I'm saying. All right, so that's an example. Another related one is you'll have mainstream macro models, like the solo growth model or others that are adaptations of that, and it'll spit out answers for what the return on investment should be, or the return to capital should be, based on how much capital a country has. And so the idea is they think they have something like this. So they have a production function, where outputs, we'll call that Y, is some function of the capital stock and how much labor the country has. And, it's something like this. It's a concave function, right? So the marginal increment in output, if you add more and more units of capital or labor, keeps getting smaller. The marginal product goes lower, right? And so using this approach, they'll look at different countries and they'll try to calibrate it, and they'll say, well, they should have the same technology because the engineers in China can study in the United States, so it's not an issue of that function F being different. And then they try to adjust for the difference in the capital stock. And they adjust for, differences in the training of laborers, like labor skills. And then they come out and it doesn't make any sense that the return to capital, in other words, like if you invest $1,000 in a type of business in China or Russia or some other country like that versus in England or the United States, it's for some reason the return to capital is higher in these other countries, and they can't explain it with the model. In other words, the difference in capital stocks between China and the U.S. would have to be huge to explain why is it that if you invest abroad in some of these less safe countries, your return on investment on average is so much higher, and they can't figure it out. And nowhere in and so I was sitting in a class, and this guy was talking about this problem, and never once did he mention anything about institutions, right? So it was all a matter in his mind of technology, and the answer has to be either we're mismeasuring the capital stock. Maybe the U.S. really has a lot more capital than we think compared to China, and then, they would think about maybe it's like human capital because people are, living in New York, and you build up this sort of rapport with each other or something. Maybe there's economies of scale. That's the way they're thinking of it. And never once did they say, well, maybe it's because in these other countries there's not as much of a property law and rule of law, and so that you could be expropriated. So, of course, if there's a greater chance that your business is going to be nationalized, you're going to need a higher expected return before you go in the first place. And yet it's not that they considered that and rejected it. It didn't even occur to them that there could be an institutional reason. It was all, if you see different rates of return, it must have to do with calculus somehow, or these, the capital or labor that get plugged into the equation. So that's another example of how, an Austrian or just even a non-neoclassical approach will solve what is puzzling these guys. Okay, the next one comes from Stephen Landesberg. Now, he has a column on Slate. I don't know if he still does, but he did for a while. And so here, this one, let me explain this to you. So I'm quoting from his thing. So first of all, he started out by saying to the reader, because he teaches at the University of Rochester, and he started explaining that, my colleagues and I, we're actually a pretty smart bunch, and he builds them up a little bit. And then he said, I'm not saying this to brag, my point is just that we're not a bunch of morons. And then he says, but yet, so this is Landesberg now, somehow last summer we managed to spend a week in a state of collective befuddlement, obsessing over a seemingly impenetrable conundrum that came up over lunch. If people stand still on escalators, then why don't they stand still on stairs? All right, everyone? Okay. If people stand still on escalators, then why don't they stand still on stairs? And then he says, he goes on, he says, for those of us who were too dense to see what all the fuss was about, one of our colleagues spelled out the paradox. Taking a step has a certain cost in terms of energy expended. That cost is the same whether you're on the stairs or on the escalator. And taking a step has a certain benefit. It gets you 1 foot closer to where you're going. That benefit is the same whether you're on the stairs or on the escalator. If the costs are the same in each place and the benefits are the same in each place, then the decision to step or not to step should be the same in each place. In other words, a step either is or is not worth the effort, and whatever calculation tells you to walk or not on the escalator should tell you to do exactly the same thing on the stairs. Okay, so just to make sure you understand what he's saying, he's not saying you should walk or you shouldn't. He's just saying you should be consistent. So that if you're the type of person that when you ride the escalator, you just sit there and don't take steps, then why, when you approach a staircase, don't you just sit there and not take steps? Right? Or, by the same token, if you take steps on a staircase, well then logically, unless your preferences change, you should be walking up the escalator as well. Because again, he's saying as economists, we're supposed to be able to explain things in terms of marginal analysis. So, in fairness to them, of course, they all knew that's crazy. It's not like I made a joke that I emailed him and he didn't answer, and I said, I hope he's not stuck at the bottom of the stairwell. Obviously, they know that can't be right. They know there has to be, so they're not crazy in that respect, but the point is, the way they're analyzing stuff, they actually got tripped up, and they had to sit there, and like he said, it took them a week to figure out, to their satisfaction, what the answer is. And so I'll read you what they said, but I don't think they actually hit the nail on the head as to what the problem was. Regarding escalators, the solution came in a blinding flash. Marginal analysis does work. It is right. Oh, let me just back up. So he spends a lot of the article explaining how most of the week what they were doing was they were coming up with reasons that marginal analysis breaks down in this case. Because everyone knew the answer has to be, it makes sense for you to walk up the stairs take steps on a staircase, but not on an escalator. And so they were reasoning in terms of, the whole thing. The benefit of taking 15 steps up a staircase is more than taking 15 steps up the escalator. But they were saying, but we should be able to do it in terms of the marginal analysis, like each individual step, because that's what we do as economists. So how come it doesn't? And so he said most of the week they were trying to explain the problem away by saying, oh, in this case, marginal analysis doesn't work. That's what's tripping us up. And he's saying, no, you can use marginal analysis. You just have to do it right. So it is right to compare the costs and benefits of each individual step. But before you can weigh cost against benefits, you've got to measure the benefits correctly. And in this case, getting 1 foot closer to where you're going is the wrong way to measure benefits. Who cares how close you are to where you're going? What matters is how long it takes to get there. And benefits should be measured in time, not in distance. Okay, so again, Landesberg and his colleagues came around and said, oh, you know what was tripping us up is when we were trying to do marginal analysis, the cost of taking a step or like the energy or the fatigue in your leg or whatever, and that's basically the same, let's say. And then the benefit, we were erroneously were saying you get 1 foot closer to where you're going or 1 step closer, but that's not the right way to measure it. Let's just say how much time it reduces between when you're going to arrive at your destination. So I actually don't think that that's right. I don't think that's what he was doing. I don't think that was the problem, what they were doing. I think the problem was they were using an objective, or they weren't being subjective utility theorists. That they were wrong when they said getting a step closer to where you're going is the same whether you're on the staircase or on the escalator. And just to give you, it's such a basic point, but to me that's like saying, to be tripped up by that, let's say you have a nice bar laid out and you have, shots of bourbon and shots of other things, and then you also have this vial of an antidote to poison that tastes disgusting. And Landesberg to me almost seems to be saying whether or not someone just poured the poison down your throat, the cost of drinking that vial of the antidote should be the same, right? The cost is the energy that your bicep uses in bringing the thing, and the benefit is you get antidote into your stomach. And that's the same, right? Whether you have poison or not. And of course that's so crazy that no, it's not the same, but by the same token, getting 1 foot closer to where you're going, I think it's fine to talk about the benefits using the dimension of space rather than time. But the point is, if you're on a moving escalator, getting 1 foot closer is a different good than if you're on a stationary staircase. And, that's again a very basic point. And then the poison analogy, it's really obvious, but I think it's the same thing going on there. But again, the mainstream economists, because they tend to think in terms of objective utility functions, even though they say, oh, no, we don't really believe in it, and we know it's not interpersonally comparable, that is what he was doing there. Okay, let's read one from David Friedman. So David Friedman is Milton Friedman's son, and he is an anarchist, not a Rothbardian anarchist. He's more of like a pragmatic anarchist in the sense that he thinks, it's more, in a market there'd be more efficient laws and so forth in terms of economic efficiency if the government didn't intervene. So it's not that Friedman's coming at it from a natural rights point of view. But anyway, he is an anarchist. He's a very sharp guy, but this particular example I've always thought was wrong. And incidentally, on my Mises archives, I talk about some of these in case you want to go and see it spelled out more. So the one I just did with the staircase, the title of the article was Escalating Confusion. And then this Friedman one, I think it's called something like The Case of David Friedman. And then the one that's going to come after this, that is the most titillating, as we'll see, that one's called something like Check Your Assumptions or something like that. All right. Okay, but anyway, let's back to Friedman here. So this is out of his price theory book and also his book Hidden Order, I think. All right, so he says, you've just bought a house. A month later, the price of houses goes up. Are you better off because your house is worth more, or are you worse off because prices are higher as a result of the price change? Most people will reply that you are better off. You own a house, and houses are now more valuable. Okay, so again, just to make sure you caught this, he's saying, you talk to the average person, and the whole point of this is he's going to show that the layman's thinking about house prices is wrong, and only we smart economists who know indifference curve analysis can see why the layperson's knee-jerk answers are stupid. Right? So that's the context of this. So he says, you talk to a person who just bought a house, they're going to tell you that they're better off if home prices go up. Right? That they tend to think that. And the trade-off is if the price of homes goes up, obviously you're better off because the asset you own gets more expensive. But on the other hand, in general, if you're a consumer, rising prices isn't good because that means you can buy less stuff with your income. So he said, but of those two things, most people think that the trade-off falls on the side of home prices go up when you just bought a house, you're better off. Okay, and he says, okay, now a month later, the price of houses goes down. Are you worse off because your house is worth less, or are you better off because prices in general are now lower? And he says, most people reply that you are worse off. The answers seem consistent. It seems obvious that if a rise in the price of housing makes you better off, then a fall must make you worse off. And then Friedman says, it is obvious but wrong. The correct answer is that either a rise or a fall in the price of housing makes you better off. And we can see why, and he points to indifference curve analysis. So let me just put this up here so you can see what his argument is. So again, to repeat it while I'm doing this here, he's saying the layperson is wrong for thinking that homeowners benefit from rising home prices because and that they lose from falling home prices. He said actually, once you buy a house, however prices change, that makes you better off. So the way he does his argument is he has amount of housing on this axis, and then here he's got amount of everything else. All right, and so there's indifference curves, right? So various bundles of a person spending more of his income on a bigger or nicer house. And so just think of it in terms of square footage, and that the same quality of house. It's just it gets bigger the more you want to spend on a house. So the less you spend on a house, of course, that frees up your income to buy anything else, right? And the trade-off, of course, these are due to your preferences, your subjective preferences. Now, the way to mainstream thing, what's the optimum point? What bundle does the consumer buy? Let's say this is the initial budget constraint, right? So the slope of this has to do with the relative price of housing compared to everything else. So this is the optimum point. So Friedman's saying you initially buy, that much housing and this much of everything else. That's your initial bundle. He said, now if the price of housing goes up, it's true you're better off. But he said, but let's see why you're better off. So if housing prices go up, that means that the trade-off gets worse, right? So, but you have your initial bundle A. So the new budget line is like that. And then he says, now optimizing on this, it's somewhere out here. And so notice that B is on a higher indifference curve than A. And so he's saying what you do as a consumer when the price of housing goes up is you sell your initial house and then you buy a smaller house, right? Because you're buying less housing, but that you're better off because you gain money on that house sale. So it's going from here to here is an improvement. You couldn't have done that originally, but what happened is you bought the house, prices went up, you sold it, and then part of that gain you used to buy more of other stuff, and you cut back on your, as housing became more expensive, you cut back on how much housing you were consuming. That's the idea of what's going on here. So that kind of makes sense, except that's not what most people think when they think that a rise in home pricing makes you better off. It's not usually because they think, you'd sell your house off and buy a smaller one. But okay, fine. But then he says the really counterintuitive thing is even if the price of housing falls, you're better off. And then, because what happens, of course, you probably can see this coming, is that means now the trade-off goes the other way and you can buy a lot more house than you could if you spent all your income on housing. Now you can get a house that's this big. And you move, again, to a indifference curve up there somewhere. And again, you're on a higher indifference curve. And so what happens here, in terms of this diagram, is if housing prices fall, you sell off some of the other stuff that you were going to buy, or you buy less, amount of everything else and buy more house, or buy a bigger house. And that makes you better off. Okay, so either way, he's saying you win. So the trick in this, so everyone, you think you see the analysis, but something seems like that can't be right. And I don't think it's right. And the reason, this analysis here is true, is correct insofar as it goes, but I think what it's leaving out is he's trying to use a static indifference curve analysis to capture the effects of changes over time. And so he's trying to use this static diagram to show what if you buy house bundle A at time 1, and then at time 2 you sell bundle A and switch to bundle B. And he thinks he can handle that kind of complexity just by assuming there's a consumer who buys bundle A when in the world of this model there is no time. The trade-off between housing and the amount of everything else is a one-shot decision you make, and that's it. Whereas if you wanted to instead have a model that had different time periods, you could do that, but then it would be a lot more complicated. You could use indifference curve analysis, but then, your diagram would have to have different dimensions for time, if you get what I'm saying. Whereas this is a timeless analysis. And just to, rather than trying to talk you through the logic of why I think this is wrong, let me just switch the example. He could do the same thing to show that if you bought gold coins as an investment, you're better off if their price collapses. Right? I could draw the thing and say initially you buy amount of gold coins, amount of everything else. Then tomorrow, there's a breakthrough in alchemy, and people can make gold for $1 an ounce, and so the price collapses, and you're better off because now you can buy a lot more gold coins than you did the day before. Whereas if you think through it, no. What if you just sold your house and put all your life savings into gold, and the next day gold's price collapses? That just wiped you out. You're destitute. But Friedman's going to say, no, now you can afford to buy a little bit less of the other stuff you were going to buy and buy even more gold coins, so you're better off. And so you see the problem there is the reason you want to have the gold coins is as a store of wealth. It's not because, you get utility just from looking at them. Okay? So that's part of the problem. And so here, when it comes to housing, it's a little bit trickier because housing is a flow of services. You live in a house, but it's also a store of wealth for a lot of people. And so by looking at the gold coin example, you can see, wait a minute, Friedman's analysis can't be right if people are holding something as a store of value. If that's why it achieves a certain place on the indifference curves, that's building in an assumption about its market value. Okay, so that's the specific problem I think he's making there. And again, why is that a neoclassical mistake? It's a very typical neoclassical thing to abstract away from time and to try to use our graphical tools that we know how to apply in other contexts and apply them to places where they don't really fit. Okay, let me now talk about Steve Landesberg, and this is from an essay he wrote for Slate initially, but now it's the lead essay in his book that's called More Sex is Safer Sex. And this is the kind of thing where if I had done nothing else with my career except write this as a parody of neoclassical economics, I would be proud of myself. And I think Landesberg, he has to know that this would have gotten a big splash, but I think he actually believes this, so it's not a parody on his part. He thinks this is, he thinks he's a sharp guy here. Okay, so the issue is what his thesis is, and I'll read you some quotes, but just to give you an idea, he's saying everybody thinks when it comes to fighting AIDS that what we have to do is get people to be careful, to be more careful, to, engage in less promiscuous activities, that, don't have sex with some random person you meet at the bar, just, make sure you're in a committed relationship and always use condoms and things like, right? So he said that message is totally wrong. He said it's true, we want to have the really promiscuous people, it would be better if they refrained or if they reduced their activity, but he said actually what we want to do is encourage what he calls the sexual conservatives, meaning the people who very rarely go home with somebody from the bar, that kind of person. He said, we want to encourage them to go out and have more sex. So here's the logic. So he says, you go into a bar, he said, suppose the bar contains 2 people with infection probability 5% and 2 with infection probability 85%. Let me put this up because it's going to be hard. I'm only going to draw the numbers. I'm not going to draw anything else. All right, so he says 5%. 5%, 85%. Okay, so the idea is, suppose initially the way things are, there's 4 people at the bar who are going to take somebody home that night, and 2 of them are real ladies' men or whatever, and they get around a lot, and so there's an 85% chance that they have HIV. Whereas these other people aren't very promiscuous, they're just in a particularly fun mood that night, and there's only a 5% chance that they have HIV. So if you're someone coming into this dating pool and these people are, comparable in other respects, what's the chance if you decide to go home with one of these people that you're going to get HIV? He said it's 45% on average, right, from this. So he said, now what if, instead of this, what if we could encourage people like this to get out more, to, sleep around twice as much? And he said, so it's true, on average, they're going to be now twice as likely to have HIV, because if they're sleeping around twice as much, the chance of them getting it doubled, right? So they're going to turn into 10%. We said, but what we're ignoring, so most people think, so why would you want to do that? You would want to instead, that's crazy. Yeah, you want to get these people to do it less, but having these people do it more is just going to make these numbers go up too. And Landesberg's saying, no, because what you're missing is if you got these people to double on any given night when you walk into the bar, this is what you're going to see. You're going to see 4 people who have a 10% chance, and then you're going to see, these 2 guys over here, 85%. Okay? Does everyone get what I'm doing there? Because these people now do it twice as much, and so, yeah, they're twice as more likely to have HIV, but now there's double of them in the dating pool on any given night, taking people home. So the idea is, they're like, taking one for the team by going out more. So someone, picking against it, you would much rather face this because the chance here, he said it drops to 35% if you average it out. Right? So the new person entering, if you're entering the bar and you're just going to randomly go home with someone, you'd rather enter this bar than this one. Right? That's the idea. Okay, so that's where he's coming from. Let me just pause for a second and talk about this. Somebody pointed out, and I think it's true when I wrote this article, that even on its own terms, this is wrong. That the point is not, if you're, the health czar, it's not that you want to minimize the probability from a random person going in the bar of getting HIV. Rather, you want to minimize the total per capita incidence of it or whatever. And so apparently, I haven't verified, I think it's true though, I think I checked it when a person emailed me, but I think with these numbers, there's more of, because now there's more people in the pool too. So even though it drops to 35%, there's now, here there would have been 5 people, right? The one person entering the bar and these 4, but now there's 7 people, right? These 6 people and the person entering. And so even though each person's probability goes down, if you've got more events occurring, then even though it's a lower probability per event, it's possible there's more total infections happening, even with the numbers he chose to motivate his example. So I think that's true, or at least you'd have to worry about that, and he's not worrying about it here. But okay, put that aside. It gets better. So, all right, so you get the idea. He says, but not, so on the one hand, Landesberg's saying, hey, this is a good thing. I've just shown why it's good to go, to sleep with people, right? And he says, but now the bad news. No matter how much we implore them, the sexual conservatives will neglect this benefit to others and instead focus selfishly on the cost to themselves of having more partners. All right? So the idea is, they analyze people rationally with the tools of economic analysis because it's not just about money, it's about everything, right? And they're saying that there's trade-off, when people are deciding, do I want to take home someone or not, one of the things in the back of their mind, it might not be on the, cocktail neck and they do a calculation, but he's saying one of the things in the back of their mind is, there's a chance I could get, this person could have an STD or whatever. And so that's one of the things holding them back. And so he said people, maximize, and this is the original equilibrium. And now just because we point this out, we can't expect these people to do that because really they were happy here. They had just balanced the costs and the private costs and private benefits. And here they would be strictly worse off from their own point of view than in this equilibrium. But Landesberg's claiming really what they're doing is benefiting, the person entering the bar. Because remember, if you're the one person entering the bar, you'd rather see this bar than this one. Okay, so we know what happens. All right, so he said, in economics jargon, the increased promiscuity of sexual conservatives confers a positive externality on everyone else in the dating pool. All right, so we know as a mainstream economist, neoclassical, if there's a positive externality, what do? Right. Therefore, to enhance social welfare, the government must subsidize sex for this group. Okay, now that would be what an undergrad would put, but Landesberg has a PhD, so he thinks through, right? The good economist thinks through not just the immediate, but the unseen. He said, but it must do so in a way that does not encourage sexual encounters among the already promiscuous. Okay, so you can't just pay people a bounty for every time they take someone home, because you'd be paying these people. And so these numbers would go up to, 95%, and there'd be more of them in the pool, right? And so he's saying, so we got to come up, we have to subsidize the sexual conservatives, but we have to also only, we don't want to subsidize the really promiscuous people. Okay. Our goal then should be to drive the price of condoms below zero. There's my thing. So believe me, you want me to finish this sentence. Okay. And then after we finish the Landesberg thing, then I'll turn it over to Q&A. Okay. So our goal then should be to drive the price of condoms below zero by rewarding people who use them. In other words, we should pay a bounty for used condoms. Wait a minute, it's going to get better. All right. The best of all possible bounties would be one that is more valuable to the abstemious people than to the promiscuous ones, right? So, again, we want the bounty to mean more to these people than to those people. With that in mind, the journalist Oliver Morton has made the marvelous suggestion that if at least some abstemiousness is due to shyness and the inability to find partners, while the promiscuous presumably have little trouble in this regard, then the answer might be to establish a government-funded dating service. And this would be the motto: bring us a used condom and we'll get you a date. All right. Like I said, I don't know how much time to spend on that refuting it, because if I had written that as a parody, I would have felt like Jonathan Swift, right? A couple of things. I mean, in the article, I do go through and actually say, well, gee, this can't be right, but what's wrong with it? So the one thing is, again, the mistake that I think he made, focusing on the individual rather than the aggregate outcome. So even on his own terms, it's not clear that it works out. But that might have been incidentally just with these numbers. I mean, he does give a different example where it's pretty clear that the social outcome is less incidence of disease if more people are doing it. But beyond that, I mean, there's all kinds of things, assuming the government's going to have all the information they need to calibrate the things correctly. And then I said, and really, this happens a lot with neoclassicals, is they'll focus on something that's real cute when really, on their own terms, there's plenty of other things that would make more sense. So, like, why wouldn't they pay bounties for people to be in committed relationships, and hit their 6-month anniversary and you get a check for $500 from the government or something, right? So, I mean, it's just a little bit odd that even on his own terms, he immediately goes to, let's pay for used condoms, right? And I mean, I don't want to be too gross, but if you think about it, if you're paying for used condoms, it's not clear that you're encouraging more of these people to go to the bar. You're encouraging something else. Okay, let's leave it at that. So stuff like that, or say, well, okay, why don't, instead, if they got all these, millions of dollars at their disposal that they normally would be using for this, why don't they instead find these people and pay them $10,000 to get a tattoo in a certain place saying, warning or something, or pay them, $100,000. All right, or maybe it have to be 100, but you see what I'm saying? Like, even if you grant their logic and their assumptions, a lot of times the answer that they come up with is a silly answer. Like, you could sit for literally an hour and just think of all kinds of things that would be better on their own terms than what they're suggesting. And this wasn't just some flippant little comment he wrote. I mean, because people, of course, were horrified, because this was on Slate, which is, gets decent traffic. And it seems to be very, socially harmful if you're someone who's really concerned about the spread of sexually. It seems very irresponsible is what I'm getting at. And so he had all kinds of doctors email, and he stuck to his guns. He kept, he had follow-up articles going through. And it's true that the doctors weren't able to get inside Landesberg's neoclassical framework and beat him on his own terms the way I think I could do, because these people were medical doctors, but they knew he was nuts, all right? And so they're trying to argue with him. I'm trying to think. So anyway, I'll stop. I said I'll stop there. Let me turn it over now to your guys' questions. Yeah.
Typically not flipping.
Right. Yeah. So the question is, isn't Friedman ignoring a lot of things like transactions costs? He is, and in fairness to him, I mean, he lays out those caveats. He also says, I'm assuming that people aren't, buying a house with the intention then of selling it 20 years later and retiring to Florida. So he assumes away all the reasons that in the real world people behave the way he's criticizing. So that's kind of what happens a lot in these neoclassical, finger wagging to the layperson, is they'll criticize, say, you guys think this, but that's dumb because of my diagram. And you say, but wait a minute, you assumed away the reasons that in the real world I'm right. You go, well, yeah, but I'm just saying, if we assume away that stuff. And so, yeah, that's true, but it's, you're walking around looking at housing and thinking about it wrong because you assumed away, really important elements of what's going on. So yeah, you're right, but he does acknowledge it. Yeah, sir. Okay, so the question is, if, say we're using gold as money, and then all of a sudden someone comes up with a way to make gold very cheaply, I think what would happen is the market would shift to using something else, like platinum or whatever. I understand, and I used to wonder about this stuff too. I'm not sure. I would have to, right now, I don't think I should speculate on what would happen in terms of the monetary system, but just keep in mind what you're saying. I mean, that would be great if that was like Star Trek technology and they could just, synthesize stuff. I mean, that would be a good thing. So we would all be fantastically wealthy, and you're right, I'm not sure what they would do about money. I mean, they might do a Hayek suggestion of using privately issued fiat currency. Like, if anything physically tangible we could reproduce at very low cost. Your money might just have to be some really reputable firms keeping a ledger and they're saying, okay, you have 100 units of our money, and it's just like an electronic thing. But so Hayek does have an essay in there. In my Mises archives, I do have it. It's called something like Hayek's Plan for Private Money, something like that, if you're interested. So I think it might go to that if really, but again, we would be fantastically wealthy, so that'd be a good problem to have. Yeah.
Why is there such a faith?
Okay, so the question is, why do the neoclassicals have such faith in ever more sophisticated mathematical models when clearly you read Mises or Rothbard and they seem to explain the economy better with just words? The answer is, and not that I agree with what happened, but this is what happened, is that you can be very precise with math. And so, to give you an example, in grad school I was trying to write a critique of the pure time preference theory of interest, and when I was arguing with Austrians, we just kept getting tripped up as what do you mean by the term time preference? Because it could mean a present good having more utility than a future good, or it could mean a unit of utility itself if you're thinking in terms of cardinal utility. And so there's different meanings, and in the Austrian literature I claim that they flip-flop in terms of what do they mean by that phrase time preference. Sometimes it means one thing, sometimes it means something else. Whereas with neoclassicals, I could just very quickly say, oh no, I'm talking about, it's not the beta, it's the margin utility of t divided by margin utility of t plus 1. So I mean, within 5 seconds I could make that distinction and they knew what I meant, even though it was in a, unrealistic mathematical model. So the answer is they can be very precise, and if they're talking about, if you want to isolate a bunch of different effects in a model, it's, they can be very clear about this is what's driving this result because we can tweak this thing over here, whereas in words, sometimes you make a mistake and you don't realize it, whereas the math, the inconsistency would jump out at you. So that's what a neoclassical would say if you asked them, why do you guys use so much math? Is because when we translate to math, it can be very precise, and if we prove something, we know it's proved, whereas if you prove something verbally, you really might have skipped a step and not realized it. So that's it. So for the same reason, like in geometry or other, things, they switch it to symbolic, or symbolic logic is a better one. That if you've taken a class in symbolic logic, you switch everything to P's and Q's, because if you did it in terms of words, you might, a conclusion you thought was true might seem to have been popping out from the assumptions when really it didn't follow. That's the idea. Yeah. Are you asking me personally, or are you saying would the representative Austrian economists? Okay, so the question is, would I ever use those things? Mathematical stuff. In the financial sector, it would have to get quantitative. Like you couldn't invest, choose a stock portfolio without plugging in numbers in some fashion. But that's not pure economic theory. That would be something else. So I think it depends what your boundary is. Like I'm not afraid of using game theory as a fun little exercise to spin out the implications of, well, what if we had people and we just want to focus on these 3 effects? What would the equilibrium be? Sometimes, I could do game theory with that, but in terms of understanding the market economy, no, I think it's mostly just principles. Yeah. No, so the question is the problem with what the mainstream guys were doing with the staircase example, is it that they were looking at just the isolated step rather than the whole thing? And I would say, no, that wasn't the problem. So the problem was that's where they thought the problem was initially. They thought, okay, we're getting screwed up because there must be some fallacy of composition that we just have to stop trying to be so economistic and looking at marginal. But no, you can, you better be able to answer it in terms of marginal analysis because that's what economists do. So I'm saying the problem was when they said the benefit of getting one step closer to your goal is the same whether you're on a staircase or on the escalator. And I'm saying that's what I think is the mistake they made. That they were assuming since it's the same physical thing, you're 2 feet closer or whatever it is, 1 foot closer, surely that reduction in the distance has to be the same to you, it has to be valued the same by you whether you're on a staircase or on an escalator. And I would say, well, that's not true in general. The value to me of having one more fluid ounce of antidote in my stomach is not the same whether or not I just took poison. And so why, shouldn't the fact that I'm on a stairs or an escalator change the subjective utility of getting physically closer to where I'm going? So I don't know if that, so it wasn't the 1 step versus 10 steps. It was the value of a step they thought is the same regardless of who the person is or what your circumstances are. Right. Yeah. So he's saying whether or not you take a step on the escalator, you still end up getting there. I mean, everyone knows, and the guys at Rochester knew that that's the answer. Right, but the point is, we should be able to break that down. I mean, because by the same token, like look at a plant manufacturing things. If you did everything and then right before the day you were supposed to send it to the retailer, you just didn't do it, all the previous efforts would have been kind of pointless. And so, but it seems like we want to use marginal analysis to explain production decisions, and yet, so if we want to explain what the firm's doing today, why do we have to, like, in one fell swoop take into account the whole history of what the firm's going to do in terms of marketing and retailing and so on? And so it's a little bit scary if we can't even explain something simple like walking up a staircase in terms of marginal analysis. So the point is we shouldn't have to just say, well, it doesn't work in this case. It should work. If it doesn't work, does it not work elsewhere too? Because we teach our students that economists think in terms of the margin. That's the idea. In other words, it isn't a human action to take one step up the staircase. You can say that could be an action, sure. And so you should be able to explain it. That's the idea. Any other? Yeah. Right. Right. So the question is, wouldn't they have to have perfect knowledge to know who the 5%? But that's where all the tricks were with the dating service and stuff. They're saying these guys don't need as much help getting dates, obviously, whereas these people do. So he said, if you bring us a used condom, we'll find you a date. That would appeal more to these people than it would to these people. And so you're right. Just paying the bounty for used condoms, they say, wouldn't have segregated the market. But by offering the subsidy in the form of you bring us the condom, we'll get you a date. So the subsidy is getting you a date. That's the idea. Now, I don't know if that means government-funded prostitution or what, but that's what they were doing. So they were aware of what you were talking about, and their solution was the government-funded service. Okay, I think we got time for one more. Yeah. I'm actually gonna have to say I don't know because I don't look at their thing. I'm guessing they probably. Well, no, the premium you can calculate, but the point is when you're wondering how high the premium should be, the models they use assume distribution. So no, the premium is just a straightforward calculation. So that should probably be right. Okay, I'll stop there. Thanks, guys.